Why is model-based oil forecast keep missing the mark? This is an outstanding story from oilprice.com, Irina Slav. I absolutely love Irina Slav and her sense of humor. Her knowledge is top notch. Let's go through the three top bullet points and then we'll go through the story. Many oil price forecasts, particularly those from the International Energy Agency and net zero organizations, consistently predict a glut in ignoring contradictory data or using flawed computer models. Yeah, we've been saying that for quite a while. Despite these forecasts, global oil demand continues to grow. Sorry about that. Prices frequently jump in response to threats on supply, indicating a tighter market than models suggest. Listen to this. Reliable indicators of oil demand and supply are found in physical market data, which often leads to forecasting bodies to reverse their projections and call for more oil investments. I want to give Chris Wright a shout out at the Department of Energy and the EIA in the United States. They have gotten better at not politicizing their data, unlike the foreign, the international, or the IEA is about as political as you possibly can get. Brent crude is trading about $67 a barrel, and WTI, West Texas Intermediate, is about 65. Not because the world's consuming less oil than 3 years ago when crude shot up over the $100. Oil demand has grown steadily since the 2020 slump caused by the pandemic. The only reason these forecasters, and most notably the IEA, are predicting a glut is because that is what fits their models. And she is spot on. Irina hit it out of the park because that's what I've been saying. We need trillions of dollars just to invest in meeting normal decline curves. That has not been happening. So if we sit back and take a look at whether or not it's just normal decline curves, that means demand has got to be there. And another major thing is what happens if the Russian sanctions are lifted? If Zelensky can actually understand that he needs to be the big boy in the room, get a new tailor and not from some child's wardrobe like he showed up at the White House, and actually end the war, give Russia the Crimea that his Russian bases have been at for 1 billion years, and then go ahead and then allocate that out there. Zelensky needs to end the war. If Russia ends the war and sanctions are lifted, prices are going to go up because Russia is pretty well maxed out on their EMP company's ability to increase their production. They've been able to avoid sanctions by the use of the dark fleet. They have a ballpark number of 700 tankers, and they are quite capable of keeping their oil flowing. However, that being said, they have a limited supply unless American companies could help them out and get going again. And then I think energy as an export, as a service, would help Secretary Chris Wright be energy dominant by exporting services. But anyway, she brings up some other great points. Last week, prices tanked after the meeting between the presidents of Russia and the United States as I was going in. Then the EU and Zelensky took the meeting home, and the prospects of peace began to evaporate, only to be replaced by the prospect of more sanctions on Moscow. Irina has coined the phrase, sanctions don't work as intended, and they will still mean that Russia will be able to sell all he can produce, but he's been limited in putting money back into production because he's funding the war. So he's not capable of putting out a lot and flooding the market as people are saying, oh, Russia's going to flood the market. Not going to happen. Anyway, outstanding job, Irina Slav over at oilprice.com. Also, subscribe to Irina Slav on her Substack as well, too. IEA, the next story, the IEA expects record U.S. natural gas consumption in 2025. This is from Chris Wright. Speaking of Chris Wright and the Department of Energy, I really like their reports because they have been spot on since he's gotten in there and he's really trying to hit it out. Listen to this. Natural gas consumption was high in the beginning of the year, driving our forecast. January consumption was a record 126.8 BCF, more than 5% in the record set in January 2024. Holy smokes, Batman. They estimate that the U.S. natural gas consumption decreased this spring and summer compared to consumption over the same time last year in the power sector, but that is going to be picked back up as more demand is rolling through.